to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures falling this morning as trade anxiety lingers on Wall Street. The Trump administration is pushing countries for their best trade deals as soon as tomorrow, according to Reuters. The push to accelerate trade talks comes just weeks before Trump's pause on Liberation Day tariffs expires. But it's not all doom and gloom on Wall Street. Deutsche Bank boosting its year-end target for the S&P 500 as the market recovers from its trade-induced sell-off.
Plus, investors also digesting a warning from the OECD, the Organization for Economic Cooperation and Development, downgrading its outlook for growth for the U.S. and global economies amid President Trump's trade war. The Paris-based organization slashed its global forecasts for the second time this year, citing the impact of Trump's tariffs. The OECD now forecasts global economic growth to slow to 2.9% this year from 3.3% in 2024.
Meantime, shares of Constellation Energy soaring today. The company inking a 20-year deal with Meta to sell power from its nuclear plant. The deal comes as artificial intelligence sends power demand soaring. Nuclear power has emerged as one of the biggest winners from the AI-fueled surge in electricity demand. U.S. stock futures sliding this morning amid growing anxiety around President Trump's trade war. The Organization for Economic Cooperation and Development lowering its global growth forecast to 2.9%, down from 3.3% in 2024, citing concerns about President Trump's tariffs and trade policy. The OECD trimming its growth outlook for the U.S. even further, expecting just 1.6% expansion in 2025. For more on this, I want to bring in Paul Krugman, Nobel laureate in economics and author of the Paul Krugman Substack. Paul, great to have you on. Thank you for making the time for us this morning. I know that in April, you called the odds of a recession better than even. Where do you stand on your recession call today?
A little bit lower. Possibly because, there is the taco thing. Trump always chickens out. And he does seem, at least a substantial part of the time, to back down. Now, that remains to be seen. And we have no idea, actually, literally no idea what comes next on his trade war. But things are maybe a little bit less fraught than they seemed, but it's still substantial possibility because who can invest in this uncertain environment?
Paul, with that in mind, what are the actual kind of checklist items that investors should be watching for with regard to these negotiations and determining whether or not there is a good deal that actually gets netted out on any of the fronts with trade wars that we've picked with multiple countries?
Yeah, so it's a real problem, which is that there are, in fact, no genuine deals to be had. The whole presumption of the Trump trade war is that other countries are treating us very unfairly, as he says, which is basically not true. We can talk a little bit about China, but the European Union has a tariff of less than 2% on average against U.S. products. What are they supposed to concede? What's the deal? So the real question is not what genuine deals, but whether other countries can and will devise face-saving stuff that Trump can call a victory and lead him to basically call off the dogs. And I have real doubts about that because I suspect that, in a way, I think all the people talking about taco are in a way making the off-ramp be harder for Trump to claim victory while actually admitting defeat. And it's going to be really hard to see how this plays out.
It certainly is hard, but it seems like investors are taking the path of ignoring it, at least for now. Chris Harvey of Wells Fargo this morning saying tariff risks are already priced in, if not overstated. What do you think investors are banking on amid an environment where a Nobel laureate economist is telling me that it's hard to game out where this is all heading?
Well, one of the interesting things here is that there are three markets to look at. There's the stock market, the bond market, and the currency market. And the stock market seems to say, well, all right, no big deal. We'll just ride this out. The bond market and the currency market are both basically saying, oh, my God, right? We're slightly off the highs, but 30-year interest rates are extremely high. by any recent historical standard. The dollar has weakened even as interest rates have gone way up, which is totally not something we normally see in the United States. We look like an emerging market. In this morning's Substack, I did a comparison. I said, the U.S. data kind of looked like Mexico during the peso crisis of 1994-95. Obviously, the numbers are a lot smaller, not a comparable plunge in the currency, not a comparable rise in interest rates, but the direction, rising interest rates on a falling dollar, is something you expect to see in a developing country, not in the United States of America.
So what are the longer-term implications of that, Paul?
Well, the world seems to be losing faith in us. I mean, it's hard to read this stuff without saying that, international investors don't consider America a safe haven anymore, that they're not at all sure that the United States can be trusted to make good on its payments, that it's a place to park your money during a storm. I mean, over the weekend, Scott Bessent, the Treasury Secretary, said there is no way America will ever default on its debt. When you're saying, for the Treasury Secretary to even feel that he needs to say that is an extremely alarming sign.
And it makes me wonder, too, about more broadly how we see that playing out in the economy. If there is that potential risk of the United States defaulting on its debts that requires the Treasury Secretary to refute that idea, what does that do to our economy longer term?
Well, we're kind of a low investment economy anyway. And to the extent, and we're definitely a low savings economy, we depend a lot on a steady inflow of foreign capital. Our trade deficit is basically the flip side of foreign capital investing in America because they think America is a good place to invest. If that flow starts to dry up, if we face we talk about sudden stops in developing countries, it's not so sudden for us, but if we're definitely seeing the flood of foreign money dwindle to a trickle, that's got to be bad for U.S. growth.
What happens if you have other world economies, world leaders who stop investing in the value of U.S. growth here, specifically looking at what we've seen either on the currency front or the bond front, and how those auctions have played out in recent weeks?
Well, remember, in some ways, if we're thinking about recession risks, these are somewhat offsetting. Higher interest rates shrink investment, hurt housing. Mortgage rates are now at nosebleed levels, and that's got to be scary. On the other hand, the weaker dollar does, make U.S. manufacturing somewhat more competitive, which is a bit of a boost. So it's not clear. I mean, a recession call is not that easy because there are some cross-cutting effects. But if you were to ask me, what do I think about the prospects for U.S. growth over the next 3 to 5 years, I'm marking them way down because we're sort of steadily undermining the basis for that growth.
That's even with some of the deals that President Trump has talked about, where you've got companies who have even traveled with him on some of his international trips, his first international trip of the Trump 2.0 presidency, that were all trying to get time with foreign leaders. They got that time, and we saw a wave of deals that, from the likes of NVIDIA, from the likes of some of the cloud operators, that got announced. What is the likelihood of those not just coming to fruition, but in the billions, tens of billions of dollars worth type of price tag that we expected?
Well, if you're in the world I live in, the jargon phrase is additionality. How many of these deals are deals that would not have happened otherwise? Probably very few. Think of yourself as a foreign CEO dealing with somebody like Trump, who gets a lot of, loves to boast about stuff he's accomplished. And you were planning to make an investment in the United States, or maybe even just thinking about it, but you're going to announce it as a plan. Are you going to say, actually, we were planning to do that anyway. This has nothing to do with Trump. Or are you going to say, thank you, President Trump, for making this possible? The incentives are obvious, but it does mean that you can't take anything that people say in these negotiations at face value.
I want to end by switching gears a little bit. I'd be remiss not to ask you about the attack on international students that we've seen playing out from this administration towards Harvard University. Can you talk to me about the economic impact specifically of making the U.S. a hostile environment for international students?
I mean, this is if you want to think about even longer term, think about America 10 years from now. This is catastrophic. I mean, we are the world's leader in science, leader in research, a lot of it with really strong economic applications. A lot of that is built around research universities, and research universities in turn are built around a lot around international students. Remember, disproportionately, the international students we're really talking about tend to be graduate students. And look, I spent many years teaching at MIT. MIT science departments are not merely educational institutions. They are research hubs. They are places where the technologies of tomorrow are being developed with a mixture of industry support, government grants, and a lot of the brightest, smartest, most innovative people from around the world who are coming to America as students. Now we're saying, oh, you're not welcome, and we're going to go through your social media accounts and possibly expel you or even arrest you if you said something critical of President Trump, or just in general. Right now, if you're applying for a visa, sorry, the visa granting offices at all U.S. embassies and consulates have been shut down. This is saying, hey, we're basically destroying the American economy of 2035.
Where else do those students go, Paul? And do some of the universities start to set up shop internationally in other parts of the world, as we know that they've done with satellite campuses before?
That's certainly something that I'm sure they're all looking at. And so, yeah, I mean, one of the sort of most obvious place is Europe. Europe does have, great universities. They're not school for school on a par with their U.S. counterparts, but they're no slouches. And they can start to attract U.S. researchers, U.S.-based researchers. An awful lot of my colleagues in academia were not born in the United States, and they have home countries they can go back to. And then, U.S. If I were any major U.S. Research university, I would definitely be well underway in negotiations to either partner with a European university or create European campuses. You've got to remember, we are not the only smart people in the world. We are not the only advanced country in the world. We do a lot of things really well, but if we muck up badly enough, then there, particularly, again, Western Europe has a lot more stable policy, highly educated population. We could still, lose the global race to Europe. We seem to be working on it right now.
Paul, always good to speak with you and grab some time. Thanks so much for joining us this morning.
Thank you.
Despite a pullback in the S&P 500 this morning, it's not all doom and gloom on Wall Street. Deutsche Bank upgrading its outlook for U.S. stocks as the market recovers from its trade-induced sell-off, the firm lifting its S&P 500 forecast to 6,550, implying a gain of roughly 10% by year-end from Monday's closing level. Joining us now, we've got Yahoo Finance markets correspondent Josh Schaefer. What's behind this call here, Josh?
Yeah, Brad, I mean, essentially it's tariff math, right? So this is Deutsche Bank's chief strategist, Binky Chadha, and when he had marked down his S&P 500 target about a month ago from roughly 7,000 to 6,150, it was tariffs are going to weigh on earnings per share. If my earnings per share forecast falls from $282 to $240, which is what he had done back in April, that's a significant weight on what we're talking about as far as how the equity market would perform, right? Well, now he sees earnings per share increasing from $250 to $267. That's because Deutsche Bank's economists now see the effective tariff rate coming from about 26% down to 17%. So we had highlighted this again about a month ago when Binky had lowered his target. He had 9 different ways that tariffs could impact earnings per share for the S&P 500. Well, if you turn that tariff dial down, quite simply, it just gives you a better outlook for the index. And so he sees earnings doing a little bit better. He also notes that he feels like there's a looming relent from the administration should they essentially disrupt markets again the way that they did in April with the tariff outlook. And that's something that multiple bullish Wall Street strategists are saying right now. So Tom Lee over at Fundstrat, he holds a 6,600 call. He said at this point, investors have an idea of how the tariff rollout works. When you think back to February when we were close to all-time highs, it was all the uncertainty, right? We had no idea how any of this was gonna play out. Now we feel a little bit more confident in what the path forward is. Morgan Stanley's Mike Wilson, who has a 6,500 call, also saying something similar that essentially, okay, we've seen the playbook a little bit here. maybe we've hit peak policy uncertainty, peak trade policy uncertainty. So if my rate of change and policy uncertainty is lower, then the potential that it could weigh on the S&P 500 might also be lower with that.
It makes me wonder, too, Josh, about something I just sent over to you with Bank of America looking at tech positioning, saying that their positioning work suggests that tech is close to a record underweight by active funds. Is that potentially bullish for this market because we could see inflows into some of those biggest tech names that are so heavily weighted in the S&P?
Well, that feeds into what one of the bulls I just mentioned, Tom Lee over at Fundstrat, keeps talking about, right? He keeps talking about it being a hated V-shaped recovery. And he's using AAI sentiment over a 6-month rolling average. He's using the amount of cash you see on the sideline, $7 trillion in money market funds. And he's also talking about where specific hedge funds are positioned and things like that. There's a lot of people that haven't come back into this market necessarily and have tried to chase this rally higher as it's happened, which is also why strategists would tell you the rally happened so quickly. But yes, Maddie, I do think there's a feeling that after all of this repositioning, perhaps there's just simply more flows to come back into the U.S. and come back into U.S. big tech specifically. And we know if big tech keeps rolling like it was over the last month, the last 2 years of evidence show you what that can do to the index, right? So that gets you a little bit higher.
Is it institutions or is it more retail, like we've seen really kind of be the thrust point of?
I think the argument right now is retail has already kind of come in, right?
Okay,
so we've talked a lot over the last month about the large amount of retail flows that we saw through that dip, right? It's the institutions that actually dialed it back and haven't necessarily fully come back in. So you had your retail buying, right? We talked about the retail traders perhaps winning that rally. Right. Maybe it's institutions now that also join the party. And then if you have flows coming from both sides, well, that would make the index go up.
Josh, thank you so much. Appreciate it as always. Coming up here on the Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, Constellation Energy surging amid a big deal for AI power with Meta. We'll get you those details ahead. And one of Tesla's biggest bulls is selling shares. We'll discuss that and more on Morning Brief ahead.
Now time for some of today's trending tickers. We are watching Constellation Energy, Merck, and MoonLake Immunotherapeutics, and we've also got Snowflake that we're keeping on tabs here this morning. First up, let's go to Constellation Energy. Constellation Energy rallying after Meta signs a 20-year agreement to buy nuclear power from the company. Starting in June of 2027, Meta will buy roughly 1.1 gigawatts of energy from the company's Clean Energy Center in Illinois, keeping the plant in business. After it was in danger of closing, take a look at Constellation shares. They are moving higher, ripping to the upside by about 12% here this morning, and notably within this, they said that they've embarked on this understanding and helping to grow nuclear energy in the U.S. Responding to these needs, 20-year agreement with Constellation, we mentioned, secures the long-term operation of that Clinton Clean Energy Center here. And it seems like there were over 50 qualified submissions that Meta had actually gone through and sifted through as part of its RFP, its request for proposal process, from a range of participants within the nuclear ecosystem. Constellation, the winner of this deal.
It is a huge deal for Constellation, especially given that the catalysts for this name are nowhere near over. We had a slew of tech companies, including Google, Meta, and Amazon, signing a pledge back in March to triple nuclear energy usage worldwide by 2050. So this is just the beginning here for Constellation. If we can take a look quickly at the year-to-date action here for this stock, obviously a lot of negative sentiment around it, surrounding a rollback, an expected rollback in funding from the administration for some green initiatives, and that's why you saw a big dip. But after this news and some catalysts from the One Big Beautiful Bill, you can see this stock is now up 40% year to date here. Well, next up, Merck has held talks to buy Swiss biotech company MoonLake Immunotherapeutics for more than $3 billion, according to a report from the Financial Times. Merck reportedly submitted a non-binding offer for MoonLake earlier this year that was then rejected, but then we did have the talks revived, according to people familiar with the matter here. Again, there's no certainty that a deal would happen, but there is also a possibility that other buyers could potentially emerge going forward here. Perhaps that's why we're still seeing this market action be relatively muted for Merck. It's down about 0.3%, but you've got a huge surge for MoonLake Immunotherapeutics here. Merck, MoonLake, Goldman, and Morgan Stanley declined to comment to the FT, but apparently, according to the reports, Morgan Stanley and Goldman are advising MoonLake on this sale process here. And we do have some analyst commentary coming in. Citi's analyst Samantha Simonenko saying the rejection of the offer is unsurprising, given that a $3 billion offer would only represent about a 16% premium here, but they did flag that they've thought of MoonLake as an attractive acquisition target for the company.
Look, this is all because Keytruda has really been the all-star performer for Merck for years. However, you've got this patent cliff in 2028 that's certainly going to be noteworthy for where the business has to start to look across some of the other either R&D that it's doing in-house to really prove dividends or start to make some strategic acquisitions. And this is a really key one here. For those who are wondering just exactly what MoonLake and MoonLake Immunotherapeutics business does here, at the end of the day, it's really coming back to some of how they can attack through antibodies inflammations. And one of the things that they're kind of antibodies that have been in trials and that they're looking to get more approvals for as well. Everything from rheumatoid arthritis, liver inflammation, neuroinflammation, any inflammatory illnesses is exactly what this company has really been prioritizing some of their own solutions around, and we'll see what more advancements they're able to bring to market and if this deal gets done at the end of the day. Also, finally, Snowflake agreeing to buy database startup Crunchy Data. According to the Wall Street Journal, the deal is valued at roughly $250 million. The company is hoping to attract more customers that want to build their own AI agents. They're taking a look at Snowflake. Snowflake shares are up by about 0.4%. Usually the company making the acquisition, you see them actually move lower on the deal announcement. However, investors could be cheering this one and the size of the deal strategically and how immediately accretive or a runway it has to be a growth driver for the business as well.
Yeah, a business that has had a very rosy 2025 thus far. I believe the shares are up around 36% year to date. Its competitor Databricks also involved in a similar acquisition with the company Neon earlier this year. So it's interesting to see Snowflake trying to kind of do the same thing with this acquisition of Crunchy Data going forward here in a hope to kind of simplify the process of moving data into Snowflake, which they see as a potential competitive advantage. Well, Dollar General is climbing after topping first quarter expectations and raising its outlook for the year, boosted by demand for affordable essentials and economic uncertainty. The discount retailer expecting to be able to mitigate the potential cost impacts of tariffs. Joining us with more, James Gellert, Rapid Ratings Executive Chair. Great to have you here. I know you rated Dollar General's financial health at 64 out of 100. It's above the retail sector average of 55. Walk us through how you're viewing these results.
So, Maddie, these results, I think, are indicative of a couple of things. One, from a tariff perspective, Dollar General has done a pretty good job of forecasting that they would have limited effects from tariffs. They buy a pretty small percentage of their goods from overseas, non-U.S. Entities. So that's positive. The other is that this is definitely a sign that the more budget-oriented consumer is active and is active in more budget-targeted stores. So I would expect to see some good results from Dollar Tree tomorrow, as well as Dollar General today. And these are I think quite strong. The market's obviously reacting well, and their forecasts were also lifted. So I think they're talking now about a 2.5% same-store sale figure for the balance of the year, which is up from analyst expectations earlier this year.
How do you anticipate going forward that this business is going to be able to navigate some of the inventory issues, especially knowing how it could change on a dime and they're going to have to be forced to figure out, do we have enough inventory to get us through not just summer, but maybe even into the back to school season and then into fall as well? How is the company talking about this?
Well, the company's been focused on inventory management and better inventory management, having more inventory on shelves really all year. It's been, I think, a part of the company's focus overall. Mm-hmm. That said, every retailer is facing a similar problem right now, which is that their suppliers and those whose goods they have on the shelves are having a very difficult time forecasting their own inventory management. And as you go up in the supply chains of these companies, you're getting into smaller and smaller and more private companies. 75% of most companies' supply chains are made of private companies. And these are the entities that are being really affected the most by the actual costs of tariffs, but also the difficulty of planning their businesses around the specter of tariffs and the difficult time that everyone's having in determining exactly what their cost base is going to look like for the balance of the year.
Yeah.
That said, a 64 financial health rating is a very solid, and it's a low risk one, which means it's a company, Dollar General, that is better positioned than many to withstand the shocks that it's currently receiving and that it will through the balance of the year.
30 seconds left. What's the read through to Dollar Tree?
So Dollar Tree is rated slightly higher than Dollar General, but it's had a more volatile ratings trend over the last couple of years. The divestiture of Family Dollar is going to be really all-consuming for them. So I think they are also well positioned from an FHR, financial health rating perspective, to deal with some of the volatility that will be coming. They also have tariff issues that they need to deal with, but from a corporate standpoint, they're certainly distracted with very significant corporate finance activities coming up.
James, thanks so much for taking the time.
Sure, good to be with you.
Absolutely. Coming up, opening bell on Wall Street. Stay tuned.
That's your opening bell on Wall Street. Taking a look at live images from the New York Stock Exchange and the NASDAQ. But let's do a check on the major averages this morning. We did have a green day to kick off the week here, but now we're taking a look at where the major averages are. You're seeing your Dow Jones under just a touch of pressure, but you've got green on your screen for your S&P 500 up just above the flat line. Your tech-heavy NASDAQ, I think, still adjusting this morning, but we did close in the green to kick off the week, and now it looks like we are up to start the day about 0.3%. Just want to quickly give a look at the bond market because this is something that I have been keenly watching, taking a look at yields here coming in just a touch on your 10-year and your 30-year yield. It's been interesting to see the traders have been obsessed with global bond auctions as an indicator of where investor sentiment lies and where investors want to be parking their cash amid this sort of re-rating of global powers. That's something we're going to continue to cover throughout our programming here this morning. Also, lastly, going to take a look at the dollar that is up this morning, bucking a trend that we have seen as of late. Brad?
It's time now for today's strategy session. JP Morgan CEO Jamie Dimon weighing and warning on the bond market. This comes as institutional investors shun long bonds. Joining us now, we've got Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Great to have you here in studio with us this morning, just after the bell. As you think about the bond market, what is your kind of overall assessment, given the interest we've seen in duration right now that investors are clearly favoring?
Yeah, I think right now the market's been caught between, we have policies that on the one hand will boost growth, like expansive fiscal stimulus. Yeah. Then we have some that will slow growth, like tariffs. We have some that boost inflation. We have some that will probably bring down inflation. So the bond market's just caught in the middle. But as you mentioned, there's a global trend at the long end towards higher yields led by Japan, and that's having an influence on the U.S. market as well. So we're looking at a steeper yield curve as kind of the dominant trend.
Yeah, and what are you telling clients about the longer end of the yield curve and what that kind of indicates about where the economy may be heading?
I'm not sure it indicates a lot about the economy. I think it reflects a lot of worries and uncertainty. And we haven't seen this for decades. I've been doing this a long time, and we haven't worried about the 30-year for a very long time. But now, because we have this deficit that looks like it's going to continue to rise, we have rising yields in other countries like Japan, where they kind of loosened up the reins on the long end of the market. And you can see that globally there's a rising concern about financing this debt. So we've been telling investors kind of shy away from the long end of the yield curve and stay in the intermediate term. You still get nice yields, a lot less volatility and risk.
We know that the budget bill places a lot of emphasis within the bond market as well because it really places the attention around the U.S. debt sustainability here. What's the correlation that you're tracking on that front?
Actually, there has historically been very little correlation between our debt to GDP or our deficit growth rate and yields. That's because, we're a big, strong economy.
The largest in the world.
Largest in the world. We're very wealthy. And treasuries are, the risk-free rate. We have the world's reserve currency. So there really hasn't been a price to pay for rising deficits.
Is this time different?
It feels different, partly because it's global and partly because, the markets This has been a concern for years and years, but it feels like we're hitting an inflection point where the market and bond investors are saying to Washington, you can't keep doing this ad infinitum. You can do it for a while, but at some point, we're going to demand more risk premium if you're going to do that.
Right, and I wonder too how you're thinking about one particular part of the quote big beautiful bill that's 899, the 899 clause, which would make it more expensive to have U.S. holdings in particular. How does that impact activity in the bond market when we already have foreign countries potentially being a little bit more concerned about holding U.S. Treasuries? Yeah, it's counterproductive. I wonder if when it gets to the Senate, if somebody will kind of raise their hand and say, oh, wait a minute, that doesn't help us. So we don't know what the final bill will look like. But anything that discourages foreign investment in any way, shape, or form, whether it's direct investment or through financial instruments, is going to be negative because we run a large current account deficit. We need that capital inflow. And if we're not getting it, that's going to depress our economy, and it's going to mean that yields have to rise to a level where foreign investors do find them attractive.
To what extent, and I guess compared to historical levels, should equity market investors be taking their cues from the bond market right now?
I always think they should because, you know, the old saying, the bond market's smarter than the equity market, which I should apologize for that, but I like to say it occasionally. I think they need to pay attention simply because the cost of capital is important to all the businesses that are listed on the stock market, right? Now, a lot of the bigger companies have locked in lower cost of capital a while ago. They're not really stressed out about, you know, the rising rates, but it certainly affects some portion of the economy, which will affect the stock market.
And I heard you explaining that it's really about the deficit and those concerns for bond investors, but we had Paul Krugman on earlier, and he was talking about how stock investors are ignoring tariffs, but the bond market is being the smart one and focusing on that potential risk. How much of that is part of what's going on with the bond market right now, a concern that this tariff policy is not going away?
Yeah, and it's a big part of it because on the one hand, we know we're going to get a bump in prices from tariffs. Now, whether it becomes persistent inflation is another question. If we have continually shifting tariff policy, then we could get consistent inflation because there's always going to be companies trying to get ahead of what they perceive to be a rise in their costs and pass those along. So I think the bond markets is right to focus on that. But in the long run, it could slow down the economy as well. And this is what I mean about all these conflicting kind of signals that the market's getting and why we've seen yields just kind of churn for the last couple of months, reacting to the news and then pulling back or, you know, shifting when the news changes.
Yeah, we've certainly seen that playing out across several markets. Thank you so much for joining us this morning. Really appreciate it.
Thank you.
Let's get to the three market movers you need to watch for your trading day. Yahoo Finance's Jared Blickery has more for you. Hey, Jared.
Thank you. I am watching the rest of the world break out here. I'm going to show you a couple ETFs in a minute, and then we're going to talk about some of the market leaders since that April 8th low and the blistering rally that we've seen. It's a surprising mix of big and small. And then finally, the dollar and commodities going the opposite direction, but they are dancing again for the second day in a row. So let's dial up the Wi-Fi interactive behind me. This is a year-to-date of the iShares MSCI Europe, Australia, and Far East. And so this is basically the developed world except for the USA and Canada. And you can see that on this year-to-date, we have just exploded to the upside off of those April 8th lows. And that is something that we have not seen in the US yet. We have not been able to get to all-time highs. But we did see that yesterday, and it looks like we're backing off a little bit today. And then I'm also looking at the all-share World Index, and this has reached new highs in the recent past, but it's kind of been treading water over the last couple weeks, not unlike the U.S., but nevertheless able to advance a little bit farther than the S&P 500 in the U.S. And here is the iShares MSCI France Index Fund. EWQ is a ticker. That hit a record high only yesterday, and that's looking pretty similar to the previous chart I was just showing. Just goes to show you the strength that is built up around the world, and we're just waiting for that next catalyst in the U.S. to see if we can propel to new highs, but that is something to keep an eye on there. And now I want to go over some of the post-market low leaders. So this would be since April 8th. First of all, this is what's happening today. Looks like IPO and retail are leading, but I'm going to put this since the bottom there, and we are about 2 months, nearly 2 months off of that low. Guess what? In the upper left, ARK Innovation Fund is up 40%. After that, we have my Bitcoin proxy, that's up 37%. New York FANG, we know what that is. SOX, that's a chip ETF, and then we have IPOs, then we have defense and aerospace, then we have the Mag 7 and software. That's the top row. So that is the mix of big and small that I was talking about there. ARK Innovation Fund, a lot of those, although it's led by Tesla, a lot of those other tickers in there are pretty small and disruption names. So it's interesting to see all of these kind of going up together here. I want to focus too on the defense and aerospace ETF, and this one is from iShares. Here we can see another launch off of those April 8th lows. And this particular ETF has been up 23 of the last 28 days. So that's pretty impressive there. And it's been hitting record highs on the closing basis for the last 5 days. So that's been on my radar as well. I want to close here with the futures market. Yesterday, I was noting, I'm going to dial this down to an intraday, I was noting that the dollar was down and commodities were up, and some of the metals made some significant gains. They're pulling back today, and the dollar is going in the opposite direction. In fact, I believe the dollar is just testing a 3-year low yesterday. But let me show you what's going on with copper, for instance. That's down just slightly. Here it is. Made that 2-week or, about 4-week high yesterday. Just kind of consolidating here, has not broken out yet, but silver has been on my radar. And SI equals F is a ticker. It's down 0.5% today, but it is now testing these highs from earlier in the year. And if I put a max chart on, you can see those are the highest levels since all the way back to 2011. So silver is in a position to explode to new highs here if it can finally reach that breakout. Again, just kind of pulling back today along with the gold market. And I'm going to I'm not going to close there, but I'm going to show you the gold market. Here is the year to date, and not quite to record highs just yet. 3,500 is a level to watch, but we did do some advancing yesterday, and we'll have to see if there is a catalyst that can finally catapult gold to those record highs. And then crude oil, we got to focus on that for a second. CL equals F is the ticker. That is up today, up about 0.7%. This is a year-to-date chart too, and it has been hovering near recent lows, but I will draw in a little head and shoulders inverse head and shoulders formation if it is able to catapult over 65, and that's a big level that I'm watching. So 65 in crude oil, I think that would probably gain some momentum here, and crude oil has been my barometer for global industrial demand, and so that's a very important market to watch. So you put it all together, commodities are very strong right now. That's on the back of the weaker dollar, not necessarily today. We've seen a mix here, but with the dollar threatening to break those 3-year lows, we could see additional acceleration. And you look at the bond market, even if the 30-year advances beyond 5%, if the break evens, if the inflation component of that surge as well, that only supports the case for higher commodity prices. Back to you, Brett.
Jared, thanks so much. Appreciate it. Coming up, we've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
The Trump administration is pushing its trade partners to provide details of their best trade deals by Wednesday, according to Reuters. The push to accelerate trade talks coming just weeks before President Trump's Liberation Day pause on tariffs is set to expire on July 8th. Here to discuss, we've got Henrietta Trey's Veda Partners Managing Partner and Director of Economic Policy. Always great to have you, Henrietta. 0 deals in 60 days by my count. When you talk to clients, what is their optimism based on? Because we are seeing optimism play out in the stock market right now.
It's really the same thing that it has been for months now, which is this trust in Trump mentality. So you either have folks that are in that basket, which is a good portion of Wall Street, or folks that think that the tariffs have to come off or think that they're so problematic that they're going to be forced off. And don't take the president necessarily particularly seriously. That's sort of the taco end of the spectrum. But the uncertainty and the very serious risk of uncertainty rising, especially as we migrate into sectoral tariffs and await a decision from no less than the Supreme Court about whether the IEEPA strategy can even be continued, is really causing a lot of permanent strain on the market in terms of monitoring the White House and monitoring these tariffs and what Japan or South Korea or the EU is saying. It's a lot, and sector analysts are getting their full share of paying attention to this now.
Well, so now you have a president that knows about the TACO acronym, and now we're all trying to figure out, all right, is that net good or bad for ultimately seeing some of these deals come forward, as clearly he doesn't like the question, and he could be fuming at the Resolute desk as we speak, or maybe in Mar-a-Lago, wherever he finds himself today.
Sure, yeah. I mean, it's super embarrassing, I think, for any president to have the rank and file or the stock market just not take you seriously on things like this and question your gumption. But the real issue, I think, is that whether the president cares or not, which is a question, for therapists, not economists, is more like, what should we expect to come next? So I don't really care if he wants to put tariffs on. I'm more concerned about, can he? So will the Supreme Court decide that he does not have the authority under IEEPA to impose tariffs? It's not a question, very interestingly, of whether or not fentanyl poses an emergent economic risk to the United States. It's whether IEEPA actually grants the president the authority to supersede Congress. So we're going to need to have that resolution. And unfortunately, what I'm seeing in tandem here is that we're slowly approaching the X date for Liberation Day 2.0, and we don't have any deals. Now, the White House is going to send a series of letters to what I estimate is probably about 125 different nations, just informing them of what their new tariff rate is going to be. So when you talk about investors baking in what's happening here, we are going to get information about 125 countries whose tariff rates range from 10% at the low end to 50% at the high end. And he's just going to blankly set those rates. So USTR is asking these nations to come to the United States and give them a reason to lower the rates from the 30, 40, 50% thresholds that are otherwise going to go into effect on July 9th. I think they want an excuse, they want a reason to lower them, and that's what they're asking for today.
And Henrietta, should we expect, when information about that letter comes out, should we expect the numbers to mirror the numbers that or at least the formula that led to the numbers that were announced on April 2nd with regards to those so-called reciprocal tariffs? Do we have any insight about what will lead to the numbers of those so-called reciprocal tariffs this time around?
This is reading tea leaves, and we're all doing our best to try to suss out what the president's ultimate goal can be here. I'm trying to take some guidance from the original China deal where he wanted to bring rates down from 145% to 80%, and then ultimately Scott Bessent landed at 30%, 34%. What I'm expecting is for the Liberation Day tariff rate set out in those charts to drop by at least half. So in the instance of certain nations, there's a 50% tariff rate in effect. It just so happens that we do almost no trade with those countries. The one that I'm thinking of has $293 million worth of trade with the United States, and yet they're tariffed at 50%. There's not a rational explanation for that rate because we're not buying goods from them, point blank, and we're never going to. So they need to find an opportunity to get those rates down. The letters and this request from USTR to get folks in, giving them their best offer to the president right now is that excuse. And I think the ultimate impact is going to be that for those 125 nations, we see tariff rates come down by at least half. So if it's 30%, maybe the rate goes down to 15. If it's 50, I'm optimistic it goes even below 25%. But I think some of them are so outlandish as to have to get cut below where they are right now.
Henrietta, while we have you here, the Senate is also set to negotiate on what is called the Big Beautiful Bill here, and ultimately we will see what they chalk up and ultimately might send back to the House for approval here. What are your anticipations?
Sure. I expect with 70% odds that the Republican conference will be successful here. I'm expecting the bill to pass around the week of July 24th. So that sequencing is that it goes through the Senate over the next 3 or 4 weeks and gets to their floor with modifications, including material reductions to the House's cuts to Medicaid. They're probably going to have to tweak the SALT deduction, and they're going to cut in half the $572 billion worth of cuts they made to the Inflation Reduction Act. A lot of those tax credits are really popular in states that are critical for the 2026 elections, including in Alaska, Maine, North Carolina. They need to maintain a lot of those tax credits because they're so job creating. And ultimately, that package will get sent back to the House at the end of June. It'll materially increase the deficit, and President Trump is just going to have to twist arms on the House side to get them to support it.
Henrietta, thanks so much for taking the time here with us this morning. Appreciate it.
Thanks for having me.
Coming up, Kathy Wood's ARK Innovation ETF trimming its Tesla holdings. We'll talk about why after the break. Kathy Wood's ARK investment trimmed its holdings in Tesla ahead of the EV maker's expected robo-taxi rollout. The ARK Innovation ETF sold nearly 50,000 shares last week for an estimated $17 million.
And ARK's trades came as Tesla prepares to launch its robotaxi service in Austin next week. Last week, Musk wrote on X that Tesla has been testing self-driving Model Ys in Austin with no incidents. So some interesting moves, given Wood has long been a bull for Tesla stock, mainly because of her optimism about the EV company's future dominance in the robotaxi business. Shares of Tesla moving to the upside today. I think it's really interesting that we continue to look at the ARK Innovation ETF as such a bellwether for retail in particular. Year to date, the ETF is down about 0.5% over the past couple of months in particular, really struggling. And when you zoom out, obviously a little bit more success, but of course that's in part due to the over allocation to large cap tech names.
Yeah, I was taking a look at a few of the stats within the components within this ARK Innovation Fund. And for ARKK, Tesla still is the outsized weighting, 12.6%, even as of their most recent fact sheet for ARKK. And that has a market value of about $708 million, a little bit over that actually. And so all these things considered, about 2 million shares that the fund, at least within ARKK, still holds. And it still is a lot of weight that they could throw around when they do exit or enter or add on to positions within Tesla.
Yeah, absolutely. And certainly you see the market response. That's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst and Brad for Wealth after that. Stick around.